Every serious investor asks the same question before they buy a stock. What is it actually worth? Not the price on the screen, the real value, the intrinsic value. Wall Street analysts spend weeks building models to answer this. Hedge funds pay millions for software that runs the math. And retail investors, you, usually get nothing. Today, I'm going to show you exactly how Trovest calculates fair value using 3 separate methods, averages them, and hands it to you for free. No other platform does this. Here's the honest truth about the tools most investors use. Your brokerage app shows you the price. That's it. Yahoo Finance gives you a consensus analyst target, which is basically a popularity contest. Morningstar has a real fair value, but it uses one method, and it's locked behind a $200 a year paywall. Simply Wall Street gives you one method too, and caps you at 3 stocks before asking for money. No retail platform, none of them, runs 3 independent valuation methods, blends them together, and shows you the result for every stock in the market. Until now. Let's get the definition right before we go any further. Fair value is the estimated intrinsic worth of a company based on the cash it generates, the assets it owns, the growth ahead of it, and the risk behind it. The market price, that number flashing on your screen, reflects emotion, headlines, momentum, and fear. Fair value reflects the underlying business. Warren Buffett said it best. Price is what you pay. Value is what you get. Over long periods, price always gravitates back toward value. And if you know the value, you know when to buy, when to hold, and when to walk away. Think about how a doctor diagnoses you. They don't run one test and call it a day. They check your blood, they scan your chest, they listen to your heart, and then they look at all 3 together. If all 3 agree, they're confident. If one disagrees, they investigate. Valuation works exactly the same way. Every method has blind spots. A discounted cash flow model can be thrown off by one assumption. Multiples can mislead you in a frothy sector. Graham's formula can look outdated for high-growth names. But when you run all 3 and they converge, that's signal. That's when you can trust the number. Trovest uses 3 distinct valuation lenses. Method 1 is the discounted cash flow approach, the forward-looking method used by every investment bank on Wall Street. Method 2 is relative valuation, comparing the company to its peers using multiples. Method 3 is the Graham intrinsic value, the conservative, time-tested formula from the father of value investing himself. Each answers a different question. Together, they give you a complete picture. Let me walk you through each one. Start with the discounted cash flow model. Imagine you're buying a lemonade stand. The only thing that actually matters is the cash that stand will put in your pocket over the years you own it. Not the sign out front, not what the neighbor's stand is worth. The cash. So you project how much cash the business will generate. Next year, the year after, and so on for about 10 years into the future. Then you do something important. You adjust those future dollars back to today's value. Because $1 10 years from now isn't worth $1 today. Inflation, risk, and opportunity cost all erode it. When you add up all those adjusted future cash flows, you get the present value of the business. Divide by the number of shares outstanding, and you have an intrinsic price per share. So what actually goes into Trovest's discounted cash flow model? 5 core inputs. First, the company's historical free cash flow over the last 5 years. That's the base. Second, a revenue growth rate pulled from trailing results and forward analyst consensus. Third, the operating margin trend, because growing revenue doesn't matter if profitability is collapsing. Fourth, the discount rate, which represents the risk of the business and the return an investor demands. Riskier companies get discounted harder. And fifth, a terminal growth rate, which assumes the business eventually matures and grows at a stable long-term pace. The model projects free cash flow out 10 years, adds a terminal value for everything after that, discounts it all back to today, and divides by shares outstanding. That's the intrinsic value per share from the DCF side. The discounted cash flow method is the gold standard of valuation for a reason. It's forward-looking. It captures growth. It respects the quality of the business. But it comes with a warning label. DCF is notoriously sensitive to assumptions. Change the discount rate by 1%, the fair value swings 20%. Tweak the terminal growth rate, it swings again. That's why no serious analyst relies on DCF alone. It's a precision instrument, but it cuts both ways. Trovest uses conservative, rules-based inputs to control this. But even so, we never let the DCF stand by itself. Method 2 asks a completely different question. Instead of projecting future cash flows, we look around the neighborhood. If 4 houses on the same street sold for around $500,000, the 5th one is probably worth about the same. That's exactly how relative valuation works for stocks. We compare the company to its industry peers using multiples. What does the market pay for $1 of this company's earnings? What does it pay for $1 of its revenue? What does it pay for $1 of its EBITDA? If peers are trading at 20 times earnings and our stock is trading at 15, it might be cheap. If our stock is at 30, it might be expensive. That's the relative lens. Trovest doesn't just use one multiple. We use 3 because each one reveals something different. Price to earnings tells you how much the market pays per dollar of profit. Enterprise value to EBITDA strips out the effect of debt and taxes, making it cleaner for comparing capital-heavy businesses. And price to sales catches companies that are growing fast but not yet profitable, where earnings-based multiples would break down. We pull the industry median for each multiple, apply it to the target company's fundamentals, and compute what the stock would be worth if it traded in line with its peers. Then we average the 3. That gives us a balanced relative value. Let me show you how this actually converts into a dollar value. Here's a simplified example using Apple. The company's earnings per share is around $6. The industry median price to earnings is around 28. Multiply them, you get $172. That's what Apple would trade at if it were valued in line with its peers on earnings. We repeat the same process for enterprise value to EBITDA and for price to sales. Each gives a slightly different number. We average the 3, and that gives us one consolidated relative fair value. In this example, around $184 per share. That's the relative lens speaking. Relative valuation is powerful because it anchors you to real-world prices, not theoretical assumptions. But it has a blind spot. It assumes the industry itself is fairly valued. And history shows that entire sectors can be wildly mispriced for years at a time. In the dot-com bubble, every tech stock looked reasonable compared to other tech stocks because the whole sector was inflated. Relative valuation told you nothing was overpriced. That's why we never rely on multiples alone either. We pair them with a forward-looking DCF and an asset-grounded Graham method, so no single blind spot distorts the answer. Method 3 goes back to the roots. Benjamin Graham, Warren Buffett's teacher, literally wrote the book on value investing in 1949. He developed a formula that strips valuation down to its essentials. Current earnings per share, a baseline multiple of 8.5 for a company with 0 growth, plus 2 times the expected growth rate adjusted for prevailing interest rates. What this formula gives you is a grounded, conservative estimate of what a disciplined, long-term investor should be willing to pay. It's deliberately cautious. It doesn't chase narratives. It doesn't get swept up in hype. It tells you, based on earnings and realistic growth, what the business is worth today. Here's why the Graham method matters so much in the blend. The discounted cash flow can get overly optimistic when growth assumptions are high. Relative valuation can be pulled higher or lower depending on how the whole industry is priced. Graham acts as the counterweight. It's the anchor. It's the voice in the room saying, slow down, don't pay for growth that might never materialize. It keeps the blended fair value grounded in what the company is actually earning today, not what it might earn in a perfect future. This triangulation, aggressive DCF, market-anchored multiples, and conservative Graham, is what gives Trovest's fair value its stability. Now comes the averaging. The 3 methods rarely agree exactly, and that's the point. Each captures a different truth. We take the estimate from each method, equal weight them, and compute a blended fair value. In this illustrative example, DCF says $212, multiples say 184, Graham says 167, the blend 188. When the three estimates are close together, that's a tight consensus. When they diverge, the platform flags it as a wide dispersion signal, meaning the stock is harder to value and you should look closer before acting. That dispersion itself is information. Once you have a fair value, the next step is comparing it to the current market price. The gap, that's the signal. If the market price is well below fair value, the stock is undervalued, and you may have a margin of safety. If it's well above, the stock is overvalued, and you're paying for future performance that may not arrive. Trovest builds the buy zone, fair range, and overvalued zone directly onto your screen. You don't have to calculate anything. You see instantly where the market price sits relative to the blended fair value, and whether the opportunity is worth your capital today or whether you should wait. Let me pause and make sure you understand the depth of what's happening here. This isn't a surface level estimate. Each of these three methods, individually, is the kind of analysis that takes a Wall Street junior analyst a full day to build for a single stock. Trovest runs all three, for every company, on a continuous basis, pulling fresh earnings data, updated cash flow history, current analyst growth estimates, and live industry multiples. Then it blends them, applies conservative guardrails, and hands you one clean number. The infrastructure behind this is extensive, and it's the reason every other platform charges for it, limits it, or skips it entirely. Here's the part I want you to really sit with. Look at what's on the market. Robinhood shows you price. Yahoo Finance gives you an analyst target that's really a consensus of opinions. Simply Wall Street gives you one method, discounted cash flow. And after 3 stocks, you're paying $10 a month. Morningstar gives you their proprietary fair value, one method, $250 a year. Seeking Alpha is similar. None of them run 3 methods, none of them blend, and none of them give it away for free. Trovest is the only platform running DCF, relative multiples, and Graham intrinsic value on every stock, averaging them and handing you the result at no cost. Full stop. You might be wondering why we made this free. Here's the answer. For decades, the people with the best valuation tools won, and everyone else guessed. That wasn't an accident. It was a pricing model. We don't think that's right. If you're going to put your hard-earned money into a stock, you deserve to know what it's worth, using the same methods professionals use. Not one method, not a watered-down version, the real thing. That's what Trovest was built to deliver. Here's what this looks like when you actually use Trovest. You pull up any stock. We'll stick with our Apple example. At the top of the fair value panel, you see the market price next to the blended Trovest fair value, with a color-coded badge showing whether the stock is trading above, below, or in line with fair value. Right below, you see the 3 method estimates broken out individually: DCF, multiples, Graham. You can click into any of them to see the inputs and how the number was built. Underneath that, a visual band chart shows you exactly where the current price sits in the buy zone, the fair zone, or the overvalued zone. No spreadsheets, no subscriptions, no 3-stock paywall. Every stock, every day, fully transparent. Now let's talk about how to actually use this. Here are the rules of the road. 1. When the market price is 15% or more below the blended fair value, that's a serious candidate for further research. 2. When all 3 methods agree closely, that's a high confidence signal. 3. When they disagree widely, don't run from the stock, but do dig deeper because there's something the methods don't agree on. 4. Fair value isn't static. Track it over time. A rising fair value with a flat price is a powerful setup. And 5. Never ever buy on price alone. Always compare price to value. That's the discipline that separates real investors from gamblers. One last honest note. Fair value is powerful, but it's not a crystal ball. It tells you what a company is worth today based on its fundamentals. It does not tell you what the market will do tomorrow. A stock can trade below fair value for a long time before the gap closes. A stock can trade above fair value and keep climbing for years. Use fair value to understand the margin of safety, not to time the market. Combine it with Trovest's full 10-metric score, with the business quality assessment, and with your own understanding of the company. That's when it becomes truly powerful. Let's lock this in. 3 things to remember from today. 1. Fair value is the intrinsic worth of a business, not the market price, and the two are often very different. 2. Trovest calculates fair value using 3 independent methods: discounted cash flow, relative multiples, and the Graham intrinsic value formula, and blends them into one consensus number. And 3, no other retail platform runs all 3 methods, averages them, and gives you the result on every stock for free. That is the foundation of disciplined investing, and now you have it in your pocket. Next episode, we go deeper into the Trovest 10-metric score, how we grade every single stock across 10 weighted dimensions, what makes a company a compelling idea, and how to use the scorecard to build a real watch list. If this helped you, make sure you're subscribed. The link to Trovest is in the description. I'll see you in the next one.